So with CIFR's sponsorship today, I was asked to tell the audience a little bit about our project, as it very much relates to the theme of today's workshop. Our project is about systematic credit portfolio risk, and in particular on the implication on regulation for bank capital and securitization ratings. So for those of you who have not met myself or any of the team members, we come from the area of credit risk, and our big theme is to describe credit risk based on the economy. With that, we build forecasting models for credit risk, risky instruments, and we also describe the performance of credit risky instruments given the economy, in particular given economic downturns. So that is our research interest. Now, with our CIFR project that we are proposing, and we have started already on the project, to do over 3 years, we have broken that into different stages. And in the first stage, we will look at credit portfolios, and we will try to improve the current thinking on how to model or forecast levels, the cyclicality, as well as concentrations and correlations. I'll give you a few examples of what we're trying to achieve a bit later in the presentation. In our stage 2, we try to then reconcile these various measures of risk and in essence explain the capital provisioning and reserving for ADIs, that is banks, and LMIs as one of many insurers. LMIs are lenders mortgage insurers. In the third stage, a lot of these, stage 1 and stage 2 is very relevant to the area of securitization, and we analyze basically risks in relation to securitizations in the third stage. And in our last and final stage, we are reconciling our findings in stage 1 to 3 and hope to make some valuable recommendations for potential regulation. As we've heard in earlier presentations, much of the regulation we are interested in stems from the Basel Committee, so Basel I, Basel II, and Basel III. And our main point of reference is in Australia, obviously, APRA and Charles' team. A little bit more about some of the research ideas, what we are aiming to analyze. I may have to jump a few slides, but in essence, a lot in our literature has been done on in the corporate credit risk, on corporate credit risk, and for instance, what we've seen earlier in the first presentation, a big body of the work by Edward Altman has been based on in this field. Very few studies focus on retail credit risk applications. We are speaking of mortgage loan portfolios, credit card loan portfolios, student loan portfolios, and the like. In particular, the mortgage area. And in mortgage, we all know that given the unwillingness to pay of borrowers, go through a sequence of states, and we are trying to explain how these states condition on each other, and what the frequency of one state versus the other is, and also how banks may, what losses they face given the various states. There's, for instance, in the current, in the US, a big discussion as to whether banks, given a credit default event, should modify loans or whether they should work these loans out. That would be one of the examples we try to analyze. Yeah? A lot of the research questions will focus on the portfolio risk aspect. That is, if a bank holds a portfolio of loans, think of it as a mortgage loan portfolio, we are interested in the co-movement of default events across large cohorts of borrowers. And co-movement amongst the default events, but also the losses given default events. Yeah? And some evidence exists, but again, most of that from the corporate credit risk literature. Very little is known on retail credit risk. A lot of these risk measures, because credit risk is one of the financial risks which is highly dependent on the economy, depend on the basically the state of the economy. And I'll show you later there's various ways on how one may build risk models, and that has implications on both the bank capital in economic terms, but then also on the way regulation is written to require certain levels of capital. This is then leads us to stage 2, where we do want to analyze the capital adequacy of ADIs and LMIs. In stage 3, and I'll predominantly focus on the second part of this presentation, where I show some first research outputs on that area, that is the area of securitization. Securitization, as we'll see, in essence relates to the transfer of credit risk portfolios between financial institutions. And the way this is done is basically that the primary risk exposure is structured to accommodate interests of these institutions. And a big element in this is the risk assessment by credit rating agencies. And so in this particular section, the question is, how should credit ratings in particular be designed to be very informative for investors? And basically, how are they currently designed? And basically, from the comparison of the two states, we try to come up with certain minimum standards. Yeah. A similar discussion, and that relates mainly to Australia. So the securitization industry has slowed down to some degree, but similar structures have been placed in recent years, in particular now referencing to covered bonds, and that will be one of the elements of credit risk exposures we will try to look at. Most of the regulation we are then looking at are in upper terms the APS 110 to 117, and Charles, please correct me if I reference anything in an inappropriate way, which relate to the capital adequacy to ADIs, then APS 120, which has the regulation embedded for securitization products, and GPS 116, which is in very general terms provides reference to how LMIs should allocate capital. And recommendations may relate to econometric techniques, minimum standards for factor models, which are used to describe the risks in those structures. Then also, in some ways, there are benchmark parameters pre-given in the regulation, which can be replicated or verified with these models, and we try to verify some of these benchmark parameters. And I'm referring, just to give you a few examples, to asset correlations and benchmark LGD values, which are used in the IRB approaches. That is, approaches basically banks internally undertake to measure risk. There's a larger research team. Here are the key researchers. There's a collaborator from Germany. A lot of my past work has been with him. He's also involved in that project. There's the Credit Risk Research Center at the Edinburgh University. They mainly focus on consumer credit modeling, mortgages and credit risk, so they will be involved. They have done a lot of similar studies for the UK, so they have a tremendous body of experience. We also have a younger scholar joining us for the project, Yong-Wong Lee. He comes from the Manchester Business School. And then there's a larger body of PhD students involved, both at UTS as well as then at the German University and the Scottish University. So we aim to collaborate, and we had many discussions already with Charles and his team. On the German side, the project is supported by the German regulator, which sits at the German Central Bank. So the split of regulation and the way it's implemented in Germany is slightly different to Australia. Also the Global Association of Risk Professionals involved, and obviously the research center at the University of Edinburgh. We have also included some what we call subject matter experts. We have people in all the top 4 banks in Australia, so, having agreed to provide us with feedback on our study. A lot of that is very sensitive, as you may already anticipate, and so they have agreed to act as subject matter experts. We have also approached various institutions to share some of their experience. The bottleneck in that kind of research is always the data, and I think Edward Altman described it as the defaults, which you need to have to build reliable models. And we have collected over the years a quite vast data set of corporate and retail credits. In Australia, we also have some databases, but it's not complete in the sense of market coverage, and we are basically calling to all of you, and especially if you're working for banks, to work with us and possibly provide some of your experience to that project. So far, again, we have collected some of the data. We have had presentations. A lot of them that has been done in the US. We had presentations to the BIS, World Bank, OCC, and last week FDIC. And in Germany to the Deutsche Bundesbank. And we were just speaking to Charles about having a similar awareness, let's call it awareness presentation at APRA. The postdoc will join us in 1 week. He's currently on his move. And obviously we have engaged with industry. But now going forward, obviously we try to bring these research questions, which I showed you earlier, to the data and hope to write research papers on that. There's 2 examples which I want to show you because that is kind of representative of the research questions, and in details they may vary, but this kind of gives you a feeling of what we're aiming to do. And I chose a combination of stage 3 and stage 4. That is how credit ratings reflect financial risk, and how current regulation, that is Basel II and Basel III regulation, addresses those risks. And then if we then look at the empirical data, how the empirical data basically compares to the current practice in regulation. And that relates to current working papers. Now, this chart here quickly shows what securitization is. We all know this is the standard bank models. Deposit-taking capital is used for lending. In securitization, the credit portfolio is transferred to outside investors. Now, the particular element in there is that these investments are generated in a structured way. And this risk transfer mechanism causes a lot of intransparencies, mainly because the credits reside then outside the originating financial institution. Now, this is where rating agencies come in, and for some of these risk exposures, let's call it senior mezzanine investors, allocate credit ratings. And a lot of the discussion during the global financial crisis has been exactly on the accuracy of these credit ratings. Yeah? There has been also a lot of discussion on the sense or reason of securitization, because a part of it has been driven by a release of capital. So banks not only, so this traditional cycle, the reason comes from a risk transfer. So banks wish to transfer the risks out of their bank and spread them across the larger economy. And examples would be pension funds or insurance companies, which hold then these securities as assets. The criticism came from that a lot of these structures were also used to release capital from the banks. So for instance, if you transfer these risks to non-regulated financial institutions, then these institutions are not required, for instance, to hold capital, and therefore you're releasing capital which actually should be held in the system. It gets worse if then these institutions are debt financed by the banks again, because through the backdoor the risks enter onto the bank balance sheet. Now, some of the data we have collected this now comes from the fixed income area. It's an example for the US at the moment. And as Ed said, there is very few data points available in Australia. This is where we want to go, why we want to go in Australia to the retail space, because the number of observations is larger. Therefore, even given low default rates, we have data to work with. Some of the studies you could not do in the corporate credit risk area for Australia because you don't have enough event observations. In this particular study we're interested is in a comparison between fixed income products And what we see here, if we pick one, and this is a chart very similar to what we saw from Ed's presentation earlier this morning, where he had the spreads, the credit spreads for high-yield bonds, I believe. This is now for a particular rating class, not high yield, that is non-investment grade, but BBB rated bonds. And what we see here is basically the default rates, the average over the default events for given years. And the black line, the black solid line, shows the average over BBB rated corporate bonds, and the dashed line over BBB rated securitizations. Now, the notion is, from a perspective of a rating agency, they share the same rating, therefore the same risk assessment, but we see basically there's a difference in terms of the magnitude of risk outcome. Now, what is interesting is we all know that in the global financial crisis, in particular, securitizations did very poorly, and in that particular rating class, we had default rates of 40%, unheard of, similar to the example Ed presented earlier during the global financial crisis. Yet, we also see in prior years that the default rates for securitizations were generally above, for that particular example, above the default rates of corporate bonds. Now, that is one aspect. The second aspect is that obviously also the sensitivity.
Yeah? These original ratings or ratings 1 year before, what is it?
They are point in time, so 1 year before. But you see a very similar chart if you take the original ratings, because rating agencies have not changed the ratings by much. They have downgraded a few during the global financial crisis, but by and large, if you go across the whole population, you get very similar charts for both. But this would be the rating measured at 1 year ahead of the observation period. Yeah, good point. Now, what is interesting is that if you look then at capital markets, what you can do is for these bond issues, I have to speed up a little bit, but what you can do is you can look at the price at origination. So a lot of these securities are issued at par. Therefore, if you take the coupon yield at origination, you can subtract the risk-free rate with the same maturity, you can back out the yield spread as a price for risk, and you find that investors, either the level or cyclicality, that is not so clear yet, but investors price the securities differently with securitization products having a larger coupon rate or credit spread. Yeah? And so now the question of our research is, in this particular case is, well, do credit ratings, and this is what the research shows, they reflect the level of risk in average terms, so across a business cycle, but yet they do not address the cyclicality and the sensitivity to business cycles. This is an example. I just want to, this is a regression model, but this is very similar to a scoring model like the Z-score, but for securitization products. Therefore, we don't work with financial ratios, but with other information you can observe for these products. And what we can observe are credit ratings. We can observe, for instance, the size of the tranches. We can observe certain embedded options, or what is called credit enhancements. And we can observe various details on the credit portfolios. Now, there's a few things what this study shows. First of all, it doesn't really matter which rating agency you look at. They all do very similar assessments. If you actually calculate, let's say, a Barbie-Pearson correlation across the ratings, the correlation is up to 99%. That is one of the many findings, but also what you find is on top of credit ratings, so here are credit ratings as control variables, but on top of credit ratings, a lot of additional information is relevant for the realization of risk. And some of the information we always thought that was included, such as the average, let's say, credit score in the credit portfolios, yet it is significant. The second element we can do, we find is here, we have models for securitization products, here for corporate bonds. We can introduce measures for systematic risk, and we find that the credit ratings, so that corporate bonds have a lower degree of systematic risk, given the level of risk, given the credit ratings, than securitization products. That is a finding. Now, let me maybe this chart is interesting. So if you have here the economy, here is a recessionary state, here's a boom state, then the solid line would be securitization, the dashed line here a corporate bond. So given a recession, in other words, the conditional propensity to default, conditional on the recession, that is much higher in the case of securitization than it is for corporate bonds. So that is one finding. Second one, how does that impact regulation? This is sort of what we are also interested with this particular project. Well, let me jump a few slides. The impact from credit ratings to regulation is through mapping tables such as this one. And they are slightly applied in different ways in different countries. And I think Australia is actually a very advanced already in the sense that some of these risk weights, they are not coded in the terminology of credit rating agencies anymore. But this is now an example. It comes from the Basel documents. And what it does is for various products, given, for instance, credit ratings here, it allocates risk weights. Yeah? And so what banks do is they basically multiply the exposure times these risk weights times 8% to get a reference value for their capital. So that defines their minimum capital standard. Yeah? And so in particular, tables like this, which will propose certain values, they have an immense impact on how capital is allocated in the whole industry. Yeah? And they also, in essence, provide the cover and the stability for a financial system. So this little calibration table sits at the heart of how regulation is implemented. There's many other aspects to regulation, and we have heard a lot, particularly by Tony and then Charles earlier. But this is one of the whole portfolio of regulatory measures. Now, the previous research has shown, well, ratings do not adequately address systematic risk. That is one finding. Then there are differences given the same rating that some categories exhibit higher systematic risk than others. Yeah? And then the question is, do these mapping tables which are embedded in regulation, do they provide a sufficient cover for systematic risk? That is one of many research questions, but one. And this is kind of how we then link the models which have been built using empirical data to the current state of regulation. Now, I'm skipping the formulas, but in essence what you can do is, looking at historical data, you can generate a mapping function between characteristics of the securitization product and the regulatory capital. Now, if you look at a credit portfolio before securitization, that may attract, this is only an example, but that may attract a certain capital charge. Yeah? This is the wrong denomination. This comes from the expected loss, but you can do the same for the value at risk. But let's, for the purpose of discussion, say this is 8%. And we are linking this capital charge to the limit, sort of the detachment limit of a particular securitization product. We saw earlier that these securitizations are structured in tranches. And what we can do is, if a tranche has a certain attachment and detachment level, and since this curve describes, based on empirical data, the cumulative link between loss and attachment-detachment risk, we can just take the difference between detachment and attachment level as a capital charge for that particular tranche. And basically, we can link that to systematic risk. The notion is, if systematic risk is higher, then generally speaking, the capital charge should be higher, and that is reflected here. So this beta, think of it as systematic risk, which has a scale between 0 and 1 in this case, and this is then the value at risk in percentage terms, and you see that this is a number between 0 and 1. But this shows you how important it is to calibrate these parameters, these reference parameters, to empirical values, because a parameter value of 0 to 1 can lead to a capital charge somewhere between 0 and 100%. Now, regulation is somewhere in the middle, but it's very, these capital contributions are highly sensitive, in particular to systematic risk. Now, let me look at this. This is an example for the US, no worries for Australia. But basically our finding is, this is the current capital requirement on these products. So if an investor holds a securitization product of a certain rating, and all these bubbles stand for different rating classes, then this x-axis describes the current level of capital. And on the y-axis, we benchmark the so-called implied, historical data implied capital. And ideally, these bubbles should lie all in the diagonal. Yeah? But what we find is, in particular, for very well-rated exposures, AAA and the like, we find that there's an under-allocation of capital, and for higher-rated exposure, we find that there's an over-allocation of capital. In parts, how regulation is structured, that means beyond a certain rating level, you have to allocate 100% capital, which is the most conservative one could do. And this is then for the different categories. We do that for particular years, like the global financial crisis, but we can also do that average over our data horizon. And we find the same picture, an under-allocation of capital for lower ratings, an over-allocation of capital for higher ratings. Yeah? So this is an outcome of one example for an empirical study, which uses default experience, and then the goal to map that to regulation. Now, one can go one step further, and this is, we've seen earlier the calibration table as an example, and this just averages over these 5 columns. And this is the current level of risk weights, and one can back out implied risk weights. And I want to use that for a discussion later on, because as it turns out, obviously, in particular for the lower rating classes, the risk weights, in hindsight, all of it in hindsight, should have been, at least for the US, higher than they were in the regulation to adequately cover the risks. In particular, we can then do a mapping, very similar to rating classes. So we are using the current ratings, so AAA, either the risk weight should have been increased, that would be interpretation, or alternatively, the rating agency should have assigned, instead of a AAA rating, a Baa3 rating. So there's 2 interpretations to that particular table. Now, I think in terms of my conclusion, I think this particular research project is, creates value. Not so much, we don't want to dispute existing regulation, but we want to endow a broader public, and with broader public I mean sophisticated people, financial analysts, regulators, possibly academics, to use these models for entering into the discussion as to how very central regulatory parameters should be. And this goes into possibly a little bit what Tony said about risk culture. And I think we should actually span the risk culture along a second dimension, and that is also complexity. And in particular, a lot of these incidents which happened, whether it's the JP Morgan case or the LIBOR case, happened at places, not only where there was a bad risk culture, but also where it was very complex for others to monitor. So good ethics is one standard, but also being able to monitor good ethics is a second. We need to measure that. And this is where I think risk models are possibly valuable, providing more people with tools entering into the discussion. Asset correlation mortgage is 15%. Is that a good value or bad value? Well, so far, very few people know how to measure asset correlations. But if we had a regression model being able to draw the link between empirical data to asset correlation, suddenly people could enter into a discussion. And second, and this is now a problem now with these findings, they are very severe. Well, a AAA rating should have been a BBB minus rating for the US, and I think there's a couple of discussions which may spin off that. Well, first of all, the global financial crisis, was that really about the realization of a bad economic downturn, or were there other problems? So in other words, is it were there economic or non-economic reasons? There's one discussion. Second, should the US, now we see these examples for the US, should that be taken as a reference point? And very often in these studies, in the past, it had been taken as a reference point to make regulation in other countries, in particular for Australia. So are Australian securitizations as risky as US securitizations? That would be one example. Second, there's 2 elements. Should regulation change, or should the way risk is measured change? And that is also something you need to reconcile, because after the GFC, regulation has changed, and the rating models possibly have changed by the agencies. Now, given 2 changes, do the changes correspond to each other? This is still something which, in our view, has yet to be determined or to investigate it, and also a part of that possibly research project. while I'm here, two points. We're just releasing a book on credit securitizations and derivatives. If you're interested, please buy the book. And second, we are occasionally running GARP chapter meetings in Sydney at UTS in the city center. You're most welcome or invited to join us. The next one will be on stress testing and bank capital allocation around the 20th of April. And the second one will be in June 2013 on credit securitizations. Again, please join us if you have time. Thank you.